Follow at But Would You and you'll be alright. Alright. Appreciate y'all tapping back in with me today. We are on a quick call. So I do these calls at least once a month, but I try to get it closer to 2 to 3 times a month for my Patreon members, and then also really anyone that's just in my Discord. All you guys know, it's really free information. It's more so you can throw me a bone if you want on the Patreon. So I appreciate everyone that does do that. And if you don't, that's fine too. I appreciate you tapping in just to be here to catch up on this crypto education. So without further ado, what are we going to get into today? I'm going to cover market structure. I really am a big fan of market structure because it allows you to dictate the direction of the market and understand the trend that you're in. It also will help you identify if there's going to be any type of reversals or, where you can get entries, where you should be looking to get exits and things like that. If you are in the Discord, go ahead and jump into the public chat because I did drop a link, and in that link it's in a quick assessment test. So on that quick assessment test, let me see if I can pull it up for you guys on my screen here. So this is it, really easy, just a Google form, quick assessment test. So I'm going to give out all the answers on this call, but you may know some of them already. It's only about like 12 questions. So feel free to fill it out now or wait till the end of the call. Hopefully you'll be able to learn and take something from that. And I'm just going to double check here that I am live. I believe I am, but things are kind of moving weird on my YouTube right now. So give me 1 second. Let me just double check. All right, it says it's on there. It says it's on there. So drop a comment if you're in the YouTube chat. Appreciate it. I don't know why I can't see anything right now through that, but it's all good. We're going to be all right. All right, boom, boom, boom. So market structure. What is market structure? So basically, market structure is just participants in the market like you and me making decisions, right? Some are buying, some are selling. When people start buying or selling, hey, what's up, Reg? I'm going to go ahead and throw you on mute just in case you didn't know you were on mute. So market structure, people buying, people selling. And what happens during market structure is it creates higher highs and higher lows. Higher highs and higher lows in an uptrend are what you want to see. And then in the downtrend, what you want to see are lower lows, lower highs. So let me see if I can pull up this image. Nope, looks like I can't. So I'll just draw it out for you guys. So if we're on a chart just like this, and we grab our arrow tool, so higher highs. So we start at the bottom, we make a high, we make a low, and then we continue making new highs, right? So this is a typical uptrend. Easy enough so far. And the reverse of that would be lower highs and lower lows. So we come down, right? And now we continue making new lows. Now this sounds pretty basic, but it's pretty funny how many people don't really abide by this and kind of just jump in wherever, right? So the green arrow is higher highs and the red arrow is lower highs. And then I'll also mark them off with the little ellipse tool here. Okay. So you can see all these green circled areas. Those are all the higher highs. Higher highs paired with higher lows, right? So the same thing here on the low side. Each low side is continuing to get higher. So you have higher highs with higher lows, and that will give you an uptrend. So easy enough like this. Boom. One trend lined up. Another trend lined up. And we don't need to make it perfect because this is just an example, but you get the picture, right? And then vice versa, the same thing when we're moving to the downside. So you'd be in a downtrend this way. So again, easy enough. Market structure, higher highs and higher lows is uptrend. Lower highs, lower lows is a downtrend. That's the number one rule you want to understand with market structure. Again, what is market structure? It's just people, participants in the market like me and you, making buy and sell orders. We're taking the data from those past orders and we're using that with Confluence to get a trading strategy. Alrighty, so hopefully everyone can understand what is market structure. It's just how you identify a trend in the market. That's what we use market structure for. So if you're consistently making higher highs and higher lows, what type of trend are you in? And you should be able to understand that, right? This is the high, this is the low. High, low, high, low, high. What kind of trend is that? Trend line is clearly an uptrend. All right, so I know some of this is a little basic, but you'd be surprised how many people miss out on this. Now we're going to, right now we're not looking at actual candlesticks because I want you just to formulate that pattern in your mind, right? So let me change this to green just to kind of help with the mindset there, right? So that is higher highs. Again, we're going to do it one more time. Higher highs here. That's the first high. And then we continue to make a second high, third high, and a fourth high, right? Higher lows. Again, same thing. This is the low point. Oh. And then we have, another low. Whoa. And we continue to go on to make another low right here. All right, so that should be easy enough for you guys to understand. Higher highs, higher lows is an uptrend. Lower highs, lower lows is a downtrend. So why do we want to identify the trend? Anybody out there, why do we want to identify the trend? Because the trend is your friend. If you are trying to trade against the trend, that's called getting chopped, right? So in a choppy market, whether the market structure is going up or going down, if you're trying to go against the overall trend, you're going to get chopped out of the market, most likely. Now, not saying you can't have success for a little while, but over a course of time, that's not going to help you. So why, again, do we want to know the market structure? Because it will give us the trend. And once we know the trend, we can trade in the direction of the trend. Alrighty, so that should be easy enough. The next thing I'll touch on is what time frame are we going to use market structure in. So this, I'll spend a few minutes here. So market structure in a high time frame gives you a better overall idea of a trend. For me, I like to look at daily time frames, but even obviously weekly and monthlies are great as well. But dailies will allow you to, if you are day trading and you want to make a intraday trade, right, and you're overall in a daily downtrend, but you've been on a uptrend on a 15-minute chart for, let's say, the past 6 hours, you can still make money there, right? The overall daily downtrend, or the overall trend for the daily is down. So let me show you an example here on my screen. So let's say, give me 1 second, my good brother Houston's hopping in here, so let me get him in here. So, okay, so I'm going to show an exact example of this. So again, let's say the daily structure is down. So imagine that each one of these bars right here, so, so this bar right here, each one of these down moves is a day, let's just say, right? So the day is trending down. The days are trending down. Now you do get these spike ups. And you can make money on that spike up, right? You can still, if you're an intraday trader, you can still make money, but you don't want to typically trade against the trend. So it's just something to be aware of. And the point I was making there is that on a higher term time frame, you want to know the trend on a higher term time frame, and then you may use a lower term time frame to execute trades, but never forget the higher term time frame, because again, the trend is your friend. So in this example, it was a 4 hour. We were moving daily candles on the 4 hour down consistently, daily, and then I said that we reversed and we had 6 hours of 15-minute candles in an uptrend, right? So now let's say we have a bunch of these little candles just in an uptrend. Now these are smaller candles, right? Now they're not going back to these range highs yet. This is just a 15-minute time frame. So you could have made money during that, but then the overall trend will continue to the downside, right? So it's just something to be aware of. Okay, now that we did that and we plotted that out, hopefully you're able to take something from that and realizing that it is more important to make your market structure decisions based off a higher term time frame. So now we'll actually jump in and look at some real examples here. So I'm going to pull up Bitcoin only here. I'm going to pull up, what is this here? Perfect. And we're going to go to a daily chart. And remember, anyone that's on the call live with me, feel free to chime in if you have any questions or you need to stop me or anything. You're more than welcome to. More than welcome to. All right, so this is our current market that we've been in. Look at Bitcoin. You know, if you can't look at this and just identify that it's on a downtrend, then I'm going to show you exactly how to do that right now. Right? So clearly we were on an uptrend for a while and then we were on a downtrend. So let's go ahead and throw in our market examples of, you know, what a downtrend market structure would look like. All right. So we have, one second, let me make this a little bit bigger. All right. So we're going to start up here at this top. We come down and you see we make a low right here. And why do I say that's a low? You see this previous support right here. You see we came and made that low right there. And we stopped. And once we stopped right there, we reversed course to the upside. Now, again, these are daily candles, and I'm going to be zoomed in on some of these. So just remember this overall market structure. All right, so we started up here. Started at the top. Now we're here. So we started up here. We moved all the way down. We put in this low about right here. And after that low, we came back up and we put in a little high right here. And we'll move this down to our low. Okay, so everyone, you know, if you can't, let me know in the chat. But hopefully everyone should be able to kind of understand that and see that right there. Hopefully everyone will be able to understand and see that right there, right? So we started at the top, we came to the bottom here, and we bounced up and put in a little high. So we had our high, we made a low, and now we have a lower high. Easy enough. Now let's just continue on with that same exact function here. So I just copied this. We went from this high, we came down here, we put in a new low, and we put in a new lower high. So same thing, right? Let's just keep going along. New lows down here, and a new lower high. Why? Because this high, after this bounce, remember we're on a daily chart. So we moved down, and then once we made our low, we spent 1, 2, 3, 4, 5, 6, 7 days. So about a week. So 7 days, you know, from that low, it took us to climb back up and get to that high. So we put in a low, and now we made a lower high. Right? And now let's just keep moving along. We're just going to keep grabbing this right on over and keep going. All right. Now we come here, we put in a low here. Now technically we kind of put in a low right here in this region, but it's pretty much the same as here. So we're going to move down to this new low that we put in down here, new low, and the same thing, new lower high. Oh, give me 1 second. Let me do that. Whoa. New low. Boom, and new high. And we'll do it one more time just for good measure. So we grab the same thing here, we come down, we put in this low, and then we thought we would stop right here and put in a high, but what actually happened is we come up and we put in, what is this? This is a higher high. Okay, so now let's zoom out for a minute. A few different things happened there. So again, we started up here at the top. We came all the way down. Boom, low, lower high, low, lower high, low, lower high, low, higher high. So this is an indication that trend may start to reverse right here when we made this higher high. But it's also an indication, if you've been paying attention, or, you know, as you pay attention and you really start to understand market structure, this is also a chance to exit the market, right? Because think about it. If you bought up here and now the price is down to, you know, down to these lows, that's about a 50% drawdown. You know, that's going to scare anybody, but especially if you're a new participant to the market, right? So that you have that 50% drawdown, and then when you bounced here and you made a, you bounced from that low, you went up about 30%, you took out this previous lower high and you made a higher high, which is a great signal. But what do you need to do to continue that, right? It's the same exact thing. If we are constantly making lower highs, okay, so we're constantly making lower highs, but then we make one higher high. That's not a reversal, right? That's not saying, oh, now it's going up only. What do we need to do? We need to confirm our higher high. How do you confirm a higher high, right? You have to confirm your market structure. And I'm going to show you exactly how this did not get confirmed over time. Okay. So we came down, we put this low, we put in a higher high, which was great. And let's go ahead and mark this higher high off with just like something, a little star here to pay attention to. Boom, we put in that higher high, little star, great. Okay, so now we're going to use a new color. I guess I should have been using red and green all along, but I apologize. And let me change this color to just yellow. Okay, so now we're assuming that this was the low. This is our new high. And look where this lands. Look where this new low is. It is a higher low, right? Okay, so now let's go ahead and say this up here. So if we have a higher, if we have a higher high plus higher low, what does that equal? Anybody at home take a guess? It equals absolutely nothing. Shout out Conor McGregor, right? But nah, it's nothing, right? If you have a higher high plus a higher low, that's nothing. You didn't get anything confirmed. You want a higher high plus a higher low plus a higher high. Now, if you have all three of those, then you can start to develop into something, right? So let's go ahead and grab this again. So we make, this is our first higher high. This is our first higher low. But then we don't really break above here. So this is sideways. This is nothing, nothing. We get a, boom. We get a higher high. So on the next low is where we would want to start to get long. On the next low, right? And I'm going to show you exactly what I mean here. Okay, so let's mark it off again really quick, and we're going to mark it off in yellow circles so that way it makes it a little bit easier to see. Maybe. Okay, these yellow circles, right? So that was our first high. It was a higher high, which was great. So we put in a higher high, awesome. Now again, this is nothing, right? This is just sideways movement. This is nothing because, why is it nothing? Because it didn't go above, I'm going to mark this off. It didn't go above our previous high and it didn't go below our previous low. So if nothing has happened in between our previous high or our previous low, then this is just, you know, regular price action, price movement, right? So this little movement in here would be considered nothing. Again, all these yellow squigs, little squigglies here, all this would just be considered nothing, price action, until we get either a higher high or a higher low. Higher high, higher low. Okay, so let's keep going through here. Higher high plus higher low plus higher high is actually where we're going to start looking. Right? So we're going to start looking here. And if it's just two of these things, then it's nothing. So if it's just a higher high and just a higher low, that's nothing. If it's a higher high plus higher low plus higher high, we're going to start looking to get long. And let's show exactly here. So this one actually fails, but I want to show it to you guys. So we have boom, higher high, higher low, oops, higher low, yes, but nothing happening in between here. We finally come in and put a higher high, which is great. We want to see that continue. We want to see that continue to be right here. Put in, keep above this low area. As long as we're above that low is where we would look to get long and continue the uptrend, right? So if we were going to throw a trade on that, we would have our stop loss below these, and we would have our take profit. We're looking to get back into these areas up here. Uh-oh. Give me 1 second quick, guys. I got to just answer this phone call really quick. Just give me 1 second. I apologize about that. Small fire I had to put out really quick. All right. Okay, so in this situation, we would be looking to enter on our previous lows down here. Any previous low down here with our stop loss right below our wick low and our take profit at around our previous high. So you could either do here, and I say here because this is this high right here. You could go to this high right here or this high right here. Right? So this would be take profit 1. This would be take profit 2. This would be take profit 3. But you would guide the trade as you go along there and figure out which will be best for you. Alrighty. So hopefully some of that was clear. I'll run through it one more time really quick just so we can kind of get on the same page here. I'm going to erase all this stuff. And we're just going to look from the left, right? High, low, high, low, high, low, high, low. This is where we start to chop. Right here, we put in this. We equal this previous high right here. We don't come to our low, so that's a higher low, so that's good. Moving sideways. We do make a higher high, which is excellent. It looks like we're going to come down and hold as this being a new low, which would give us market structure to continue up. But ultimately what happens, we don't make that and we break this previous low, which is what? A lower low. And so now the downtrend continues. So now the downtrend would continue. And that downtrend would be moving down here. Making a small lower high here. Let me just redo this whole thing. Okay, low, high, new low. Is this going to be the new high where we continue lower? Or was this the low and now we got to come get above this area to claim new market structure? And I apologize. Whew, got hot in here. I apologize there for that little interruption. I feel like I might have thrown everyone off, but in essence, you know, we are consolidating right now, just like we did in this range here. Just like we did right here. Similar to what we did here. It's what's going on right here. The bullish scenario is that this is our new low down here. And you know, we are going to make new market structure from that low. So this would be the low. This would be the high. This would be the higher low. This would be the higher high. Now we need to come down and put in, you know, a higher low somewhere around like here, and then continue to the upside. Now this would be, you know, just like we did over here looking at taking trades. This is the same type of setup that you can take for market structure, right? So this is the same type of setup. So the 3 things that I use for trading when I'm trading, first thing is market structure. Then I use the market structure to determine the trend. Then I use the moving averages for confluence, as well as the fib for confluence. Now, this is how you create a trading strategy, right? You take a few different things that you feel comfortable with, and from those things, you try to take out the best data you can. So as far as market structure and determining trend, we've already determined we're in a downtrend. So overall, we're in a downtrend. So usually when you're in a downtrend, you don't want to fight the trend, right? You want to be shorting the market. You usually want to take shorts. And you know, if you're in the Discord, I did call out a few shorts. Not all of us in the Discord are traders, but we're all, you know, working together and learning to get there. So not saying for you to go jump in and take trades. This is not about like, oh, you know, you can make money today and you can turn $500 into 5,000 by the end of this week. I'm not saying any of that. What I'm saying is if you can learn some of these basic fundamentals and some of these principles, you can start to see this so clearly that it makes a lot of sense, right? You can see that, oh, maybe we did bottom out. And there's a bunch of other factors. These are just 3 that I think are great for beginners and getting started. So that's the goal of this. It's not say, hey, go get rich. The goal is for you to understand what's going on when you're looking at, charts, when you're looking at market structure and say, oh, this could be a trend reversal, or, oh, the trend is continuing to the downside. And not only that, it'll give you points, areas of interest to either, go long, go short, where you want to, decide what you want to do. One sec. Sorry about that. My lady just got home from a girls' weekend trip, so I think they're out there raging. All right, so market structure, hopefully you guys are good to go now. If you jumped into the assessment, I think we covered most of these questions here. And be honest with yourself. If you don't know them, that's okay, but try to start to understand them a little bit better. All right, so the next thing, actually, let me kind of round off this topic here for market structure. So again, is the same thing that we talked about as far as going long on that previous low, right? Because market structure changed. So again, we're on a daily chart, and this was over how many days did this take? Let's see. It was about 65 days, so about 2 months, right? And what about this consolidation period? This consolidation period was about 33 days. And where are we at currently with our consolidation period? About 24 days. So could be decision time here soon. Okay, so again, just like we said over here where we were watching, right? We did put in a higher high. We did put in a higher low. We had consolidation of that, right? So higher high here, higher low down here. Let me grab this just to point it out. So higher high up here, higher low down here. And then this was just continuation because there was nothing outside of this little range to change anything, right? From this top range to this little range, nothing changed in this move. So that was just consolidation. We continue, to hold this higher low. We do put in a higher high, which is great. And this is where we would have been trying to look to get long with the stop loss under these wicks. And you could wait for your entry to be at the bottom or close to the, these previous bottoms down here. And when we did that, I think it gave us a 3-to-1 risk reward. Let's double check. So if we throw on this and we say, okay, we're going to enter at the same low from here. And we're going to have our stop loss under this wick and our take profit. Let's see, it's the top. So that was a 2.5 trade there, meaning, for every $1 you risk, you'd be making $2.50. So that was for the first take profit. On the second take profit, it was more of like a 3, almost 3.5. And on the last take profit, it was closer to 4.5. So, if you're not as good of a trader, you're not as comfortable, you want that number, that ratio to be as high as possible, right? You want to risk as little as possible for you to make the most amount possible. So we have that same setup coming in down here. All right. So we got to zoom in a little bit. We have, this has been 24 days. So we had 30 days here before a breakdown, 60 days previously before a breakdown. Right now we're at 24 days. Of that 24 days, do we have higher highs and higher lows? Let's just look at it. So this was the low. This was the high. This was a higher low. This was a higher high, right? So far we are actually putting in good market structure. Okay, and now we're going to start using Fibonacci's to give us confluence of where we might take a trade, right? So overall, we know the trend is down. So let's just mark that up here so we don't forget. And we'll just say in downtrend. So we're currently in a downtrend. Now this market structure is trying to fight that downtrend. Okay, I am going to run a Fibonacci, right? So if you don't know, on the left-hand side right here, Fibonacci retracement. It's one of my favorite tools. And this, I guess I should say this first. This area is called a swing low, right? Compared to this area up here being a swing high. So what do I mean by that is just that price was coming down like there. It swung this low and then it started to come back up. And the same thing over these few days, the price swung that high and now it's starting to come back down, right? So that's just, this wick is just our swing high and this wick is just our swing low. Now we run a fib retracement. So that same tool I grabbed over here. When you are, let me type this out. When in a uptrend, swing low to high. When in a downtrend, swing high to low. Okay. So the overall big market is what? As it's said right here, in a downtrend. But this current structure that we're in is what? In a uptrend, right? You can see because we're making higher highs and higher lows. So that's this right here. This is currently trending up over the past 24 days since the 18th of June. But obviously, you know, we've been trending down for some time. So we're only focusing right now on this most recent, and we're going to run a fib from the swing low, which is right here, to the swing high, which is up here. Now you can, I'm going to turn on these fib settings just to give you an idea of what's going on. On a normal fib, all these settings are turned on. And then you have extension fibs over here and whatnot. But for me, I only use the 0.382, the 0.5, and the 0.618. And then I also set a 0.65. So I have less lines that pop up. You can change your lines to be whatever color. So I don't use the 0 typically, and I don't use the 1 as much. So let's just go ahead and throw this on and throw it to whatever color we want here. We'll just make it this color. Actually, I don't like that color. We'll just keep the color it is. Okay, and now we're going to take off everything but the 382, the 5, and the 618. So there's 3 lines, and then right under the 618 is the 0.65. All right, here's some Fibonacci quick notes that you need to know if you're not familiar with them. When you are in a strong trend, to the upside, you're most likely going to get a bounce at the 0.382 level. So that's this level right here. So let's just come down here and throw a Fibonacci on just for an example. And for this one that's down here, we'll turn on everything. So make it, you know, more similar to what you guys might see. Okay. So this is our 0.38 levels right here, this first one. So let's say the price, you know, does something like this. It runs up here and then it kind of just hangs out up here for a while and it comes down. Let's say it's a really strong uptrend. It might come here for a second and then just jump right back off of it, right? So technically this would be, you know, you have a bull flag that was building here. You have a little bit of a bull flag. You're waiting for that bull flag breakout. Then you also have confluence with this 0.382 fib. And then let's just also randomly say, you know, that for some reason this also was the moving average line was right there. So now you have a bunch of points of confluence, right? You have your bull flag, showing that usually like 78% of the time they end up in going up. You have your 0.38, which confirms that that's a good bounce spot in a strong uptrend. And then you also have your moving average. And then, you know, let's say the market structure was also making higher highs and higher lows. Then boom, that gives you 3 strong points of confluence to enter a trade. Okay, so I just wanted to point that out because when we go back up to here, if we're in a strong uptrend, right? So we're trending up right now. And the strong level is 0.382. So I wouldn't say a bounce is 100% coming here, but it's an area of interest, right? So you just want to start marking off or knowing where your areas of interest are. So that's the first one. Now you can just, if you don't want to leave your fib on, you can just draw a horizontal line like that. So I just drew a few horizontal lines and I turned off my fib here. And so now I'm just watching price. I already know that we're trying to reestablish an uptrend. We've already made higher highs and a higher high here and a higher low here. We want to see another higher high here. And then what would be a perfect, you know, continuation of that? Well, higher high, higher low, higher high. And now let's say now just the price chills right here on this fib level that we're talked about, which remember all this right here would just be consolidation, and then before ultimately coming back and let's say it makes another higher high, right? So with something like that, that would be excellent as an area to watch out for. But because we're not just going to use the fib level, we're not just using fibs to make trades, we're not going to take a trade just because of that. We still need a few other things to give us, that edge in the market. Okay, so hopefully that stuck with you guys as far as how do I throw on a fib from the swing high to the swing low, and then using that with market structure. So we'll do it one more time really quick as if, let's grab another chart and just kind of do it as an example with another chart. So we'll just grab AVAX here. I forgot this was already set like this, but okay, this is, let's use this. Okay, so AVAX, obviously everything has been trending down. So the market structure has been trending down. We put in our low where? We put in our low right here. And the current high is up here. So we run our fib. We start our fib down here. Start fib. Run it to the top up here. And then that would give us the 0.38 level, 0.5, 0.6. The golden level for Fibonacci, the level that must hold to continue a trend, is 0.618. So they call that the golden fib level. So the fib level reacts the strongest at 0.382 if you're in a strong trend. So if the trend is strong and true, you'll get a bounce at the 0.382. If the trend is going to end or possibly reverse or kind of just look like more of a sloppy market is what they call it, then the price could go all the way down to the fib, which is 0.618. Now, that is where I typically like to enter trades. If I have a fib at its 0.618 level and I have other areas of confluence, right? Like sometimes I use volume profile. Sometimes I'll use, usually really moving averages. I really like EMAs. I really like, but the point is that 0.618, if it doesn't hold to 0.618, then I'm most likely going to get out of a trade. Okay, so this was a previous example, and what we'll do is we will run a replay back to down here. Okay, so now all these candles are gone, and we are going to watch these candles play out. This is on a daily time frame. And so what happened is here on the 18th, we finally made our low, right? We finally made the low on the 18th, and then we'll just play it from here. So we made a low, and then we bounced. So this was the low, strong bounce. So for now, we're going to act like this isn't here. So act like we don't know about those fib levels. Strong bounce. And actually, what we'll do is let's just throw a fib right now from this swing low to this high, right? So this high, because at the time, this was the highest we went. What is the first high after this low? So this was the low. This was the first high. Okay, so for now, our fib is right here, and we're not in any trades. We're just watching the market as it progresses. Play. Oh, now we have a new candle, a new day. So now our new swing high fib is up here, and we're keeping our low exactly where it's at, right? So we're just following this trend move with the Fibonacci. That's all we're doing. Go ahead, hit play. Okay, a new high. That means a new fib level, or it means, correct where your fib is at. Okay, so now we get that high. And then you see here that wick, it peaked up there, so we got to move our fib just up a bit. Okay, so it looks like this might be our first day that closes red. So now we have a fib start down here. We have a fib end up top. We have our, if it's a strong trend, the 0.382 where we want to look just, for areas of interest. And if it's a trend that we might enter as a trade, we're going to wait to get to the 0.618. So we hit play. And now also with this being, if we're going to enter a trade at this 0.618, then we need to use either this closing down here as a stop loss or this as a stop loss. So just keep that in the back of your head, but go ahead and hit play. Okay, you see the market comes all the way down, but on a daily, we get a wick down here, but that wick doesn't close. It actually closes above. So let's keep playing. Okay, we do get a daily candle that finally closes down here. So now we have a wick low, we have a close low, and we want to see if we're going to get back above this 0.618. Remember, we don't have to take the trade this first time it comes down. We want to see if it's going to continue, hold here, and move back to the upside. Also, you usually want to see 2 to 3 closing candles to confirm your thesis, right? So let me write that out here. 2 to 3 closing candles to confirm idea or thesis. So if our idea was to go long at the 0.618, we get one candle, doesn't close above it, but let's go ahead and just count that as one. We get another candle right here. Oh, wow, I didn't know that. We get another candle right here, that's 2. And are we going to get 3 or more? Let's play it and watch. We come back above it. So we got technically below the 618, we got 1, 2, and then this third one's trying to fight back above it. So you could count it, but I would be very cautious right there. And now you see this wick. This is important. That wick right there was the, entry that you wanted. So you came down, you have your low, you have your high. You saw that this low does not go below your previous low. Okay, that's good to know. You know that in a strong trend, the 0.618 is going to hold. Did the 0.618 hold? Well, that's kind of debatable. It's kind of, what you have to call it, because we wicked below it here and we closed below it once, twice, and then the third time we were kind of flirting with it. And then the fourth day, we absolutely crushed it. So on this fourth day up, that would have been a great move. And you would have waited for this retrace right here to the 618 to enter, with your stop loss still being below this candle, these candles, or this wick low right here. All right. And let's go ahead and play. And if you would have played that out, it just continues out to the upside. So it would have confirmed your idea. Now, the targets weren't actually hit all the way to the upside. So this is now a pullback to the 0.382. So what does this tell you, right? The pullback to the 0.382, it tells you that if this trend, this little trend that we're in on this daily, is going to continue to the upside, then it should hold that, right? That would make it a strong trend. If not, and it comes back down here and then eventually goes below, well, you can see exactly how that would play out, with this being the high, this being the low, this being a lower high, and that move would make it a lower low, and then so on and so forth. And so that would be the new market structure. So hopefully that market structure helped you understand something. The fib levels, again, is just swing low to swing high. You can use them on a smaller trend like this, or on a very high, larger trend as well. And let's just really quick look on a higher time frame with this fib. Same idea, let's throw it on reverse. So we're going from this swing high up here to this swing low down here, right? So the two areas that I'm measuring, this swing high as well as, this swing low. And what would have, now it just continued to bleed to the downside, but say it bounced right here and came up to here. If that 0.38 level would have held and it would have went back down, then that would have confirmed that it's a strong downtrend, right? Just like the other way, when it's flipped to the upside, it confirms it's a strong uptrend. So hopefully you're able to take, away from that. So remember, you're running your fib from the swing high to the swing low if you're shorting, and you're running it from the swing low to the swing high if you're longing. Again, we don't use Fibonacci's alone. We would want to use them with some type of confluence. And that confluence, lastly, is just going to be the moving averages, which, you've probably heard me talk about a bunch if you've been following me whatsoever. So when we're on Bitcoin, let me go to a easier chart. Come on. So when you're on Bitcoin like this, a whole lot of teaching going on here. This purple line is a 20-week moving average, right? That 200, that's a 200-week moving average. Now, really quick, we're just going to throw a fib on from that swing low to that swing high right there. That moving average, because the candles are below, acts as a natural resistance, which most of you guys know. Also with that, there's a imbalance or inefficiency right here with this drop down, which is another area that you would want to watch. So when you have, let's go ahead and throw this fib on. We're going to throw this fib on from this swing high up here to this swing low down here. And so I was looking to short anywhere up to 23,500 because I think that we're in a strong downtrend overall, right? The overall market is in a strong downtrend. You want to trade with the trend. We came down, make this swing low. This was our swing high. This was our swing low. Where would we bounce from here? We have our we have our moving average right here, which is going to act as resistance. And then also remember, in a strong trend, that 0.382 acts as resistance as well. So I took a short starting at 22,500 at the moving average, and then with the stop loss above this wick high. And that was the trade strategy, right? That was one of my trade methods, or is one of my trade methods, right? So same thing. You can do it from when you're shorting. You can do it from when you're longing. So hopefully you guys were able to grab that there. Historically, the 200-week moving average has held as support for Bitcoin. When I go back here, let me try to find the chart that has it. I think it's this one. And we go to a weekly. And when we're on this weekly view, and I've pointed this out a bunch of times previous as well, but going back to even like this is 2016, the 200-week held. This is 2018, that 200-week held. 2020, the 200-week held. And when I say held, I mean for the most part, it stayed above it. And so now we're right here, and we've closed 3 weeks below it, 2-3 weeks below it. So if we don't get back above it, that could signal much, much more downside, because historically since 2016, it's held up pretty well. And 200 weeks is 4 years, right? So that's like a 4 year, about a 4 year, 41 month, I think. Or 48 months, I guess it would be 4 years. But so just be aware of that. So moving averages, when the candles are above, they act as support, they hold it up. And when the candles are below, they act as resistance. So right now the candles are below. So that's something to really, really watch. If the candles stay below, that's not a good sign. Ultimately, where do we have to get above to change market structure, or at least to think about start changing market structure, right? We got to get back above this area. So we put in a new higher high above that area, and then hold that same area as a low. And then we continue to put in a higher high above here, and so on and so forth, and continue that trend up. So those are the big things I would be watching for. And then the last thing is just the exponential moving average compared to the moving average. Exponential moving averages just means that they take more weight into the most recent data. So they just take more weight into the most recent data. So if I've marked it off here on this chart. So this 200-week MA right here. So this MA is just measuring, this is the 20-week, I'm sorry. So this span right here, not 200, this is the 20. 140 days is about the 20-week moving average. So exponential moving average will just take more account into the more recent data, right? So even if it's a 20-week moving average, if it's an exponential moving average, it's going to take, let's say, the last 4 weeks and weigh that data heavier than the previous weeks. So, all right, guys. So hopefully you guys learned something and you got to catch up on some of that. If you could, leave a comment, leave a like, leave a subscribe, all that good stuff. I'll catch y'all on the next one. And that's it for the live stream.
Thanks a lot, man.
Oh, well, yeah, if you guys want, I'll send another call invite. If you guys have questions or want to go over anything, I just wanted to stop the stream for